Welcome to Season 2 of the Bean Pod, a podcast about decentralized finance and the Beanstalk Protocol. I'm your host, Rex. Before we get started, we'd like to again remind everyone that we here at the podcast are super bullish about Beanstalk Protocol and other DeFi projects. But as we've seen time and time again, this is still a risky space. So, with that in mind, always do your own research before investing in a project, including anything covered here in the podcast, and never ever invest funds that you can't afford to lose. And with that, on with the show. Here at the Bean Pod, we love talking about the future. Our guests, the projects we cover, and the concepts we discuss are almost uniformly focused on what's happening now and how those things will improve finance, ownership, or society in general down the road. We and those around us have seen how the status quo falls short and are bound together by a desire to figure out a better way forward. But that's not to say that history isn't important. Decentralized finance is working to solve some of society's oldest problems, and, like it or not, understanding history is not only advantageous, but essential. There are few people who understand the history of finance and how it relates to modern DeFi better than Manny Rincon-Cruz. Manny is a financial historian by trade and a key part of the Buttonwood Foundation, a collection of tools and primitives that are helping developers build components of the decentralized finance stack. Manny was kind enough to join us in the studio the other day to talk about how he got to where he is now and how Buttonwood will help drive future DeFi projects. Manny, thank you so much for joining us on the podcast.
Thank you for having me.
How about you start us off by just telling us a little bit about yourself?
Of course. My name is Manny Rincon-Cruz. I'm the founder of Buttonwood, and I am also, I think in my second life, the executive director for the history working group at the Hoover Institution at Stanford University. So my background is, I'm a financial historian by training, financial historian of China specifically. And most recently, I've just been working on questions of financial innovation, kind of what drives the long cycles of these bursts of, new instruments that come into financial markets and traditional markets, how they survive, how they evolve. And I think kind of the big question for me is really, what is the financial stack, right? I mean, financial innovation, for the most part, the financial system that we have today spans about 600 years. And it's really an accumulation of about 8 key innovations. So, most things don't survive. And so I kind of want to understand what does. And
So what led you to that particular area of interest? One of the things I noticed on the Buttonwood site is it's very history driven. It's a lesson in financial history. What took you down that path, and how did that translate into what Buttonwood does now?
Well, that's a very long story of how I ended up in financial history. So when I was still an undergraduate at Harvard, my focus was mathematical logic. So it was modal logic, diagrammatic logic. Diagrammatic logic is kind of like the language spoken by the aliens in Story of Your Life and others, right? So it's a picture-based system. So then I'd left. I'd done an internship at Goldman Sachs the summer of 2008. So when everything exploded, and decided that I didn't want to be an investment banker. Ended up in China for a year, came back. And it was when I came back that I enrolled in a number of international financial history courses. And there was one that was particularly influential, I think, for most of my life. And that was a course co-taught by Charles Mayer and Neil Ferguson. And so that it was in that course, I think I sat there for the first day and it just clicked for me. It was like, these are the questions that I care about, right? What are the institutions that drive technological advancement or technological retardation? What allows some countries to grow and what makes other countries stagnate? There were these kind of big, profound questions, which I thought history answered quite well, or at least tried to, in a way that economics and political science did not. And so I left afterwards. I had a job lined up. So I went to Taiwan for another year because I had another scholarship lined up. I also had a job lined up at the Boston Consulting Group So I did that in New York City, primarily with clients that were in financial services. So insurance, credit cards, banks. There are a few others. And so the digital transformation was still underway, particularly for insurance. So that was kind of a big area of focus. But I was quite unhappy, right? I think within a month of being at BCG, I kind of knew that I didn't want to be like one of the partners there. I kind of looked around and said, I don't see myself as any of these people, so I should probably leave. And the intellectual questions around financial history, right, and history writ large were still very much top of mind. So I applied to go back to grad school. So I went back to Harvard and started grad school there. And that's when I really started focusing on, kind of what ended up being my area of expertise, which is the history of Chinese central banking, right? So I had the language skills, I had the quantitative skills, I had the industry background. So this seemed to be kind of the perfect fit. So this must have been, I think, 2013 to 2015, around that era. So as you know, Mt. Gox happened, Bitcoin was gaining steam. So the question of could Bitcoin be money was top of mind. So, I was trying to explore this question. Most academics were quite unreceptive to the idea that Bitcoin could be money, right? At Harvard Law School, the idea was that money was a creation of the state, or at least the state provided a clearing house-like service that anchored state-issued currency as the only money around, even in a commodity-backed currency system. So I ended up transferring to Stanford because I was dating my ex who got a job in Silicon Valley. We broke up before I even finished moving here, so it was totally in vain. But being in the Bay Area allowed me to then connect with a lot of crypto projects and DeFi projects. I ended up advising, Block Tower, Ampleforth, a couple other smaller projects. And it was through that I think I truly grasped a little bit more what it meant to be what it meant for finance to become disintermediated and really the advancements that would happen there. I was quite fortunate that when the bull market of 2017 hit and everyone was asking, what is money? I could raise my hand and say, I've been thinking about this for 10 years, right? And so, that kind of provided my entry into the industry. And so, that lasted for about 3 years. 2020 is when, DeFi summer happens. And, Ampleforth is half of the volume on Uniswap. And I'm looking at the Uniswap contracts and thinking that they don't make sense for rebasing assets. So I start thinking to myself, how would I design Uniswap from scratch to be compatible with rebasing assets, right? Beanstalk also has some rebate. Olympus has rebasing assets. Rebasing is now everywhere. Nobody likes to admit it, but it was actually quite a key innovation in token design. But Uniswap v2 did not accommodate it. So I started kind of experimenting, designing my own contracts. I worked with a friend to kind of get them coded up. And that was one of the most fulfilling things I'd done up to that point in a number of years. So at the beginning of 2021, so a number of people have been reading the essays that I've been writing on Thinking Farm around kind of money design, the proper use of money, how to think about, AMMs and so on. And so there were a number of investors kind of interested in supporting a project that I would create. And so, it took me a while to kind of come around to doing that. But it was around the beginning of 2021 that I said, all right, I've had a lot of fun designing protocols. I seem to be not terrible at it. So I put together a team and that became Buttonwood. Yeah. That's the long story. There you go.
That's great. I love a good long story. So, one of the things that I saw on the Buttonwood site that I want you to talk us through is it's essentially the comparison of the historical financial stack versus what exists in DeFi today. And I noticed that, there were a lot of parallels or analogous items. And then there were quite a few open items that, that decentralized finance or modern cryptocurrency doesn't have an equivalent for. Could you talk us through what that comparison looks like and where those gaps still exist?
Yeah, I feel like I have to pull up this timeline that I made really quick, which is somewhere on here.
Everybody
The
thinks Rex is just asking random questions, but I'm out here doing some research beforehand. I like reading up.
no, okay, I remember exactly now. No, I'm cheating. I think it's totally allowed. So the all right, so let me begin with this. So because I wrote this up in 2020, and one of the things that I learned in 2020 is that the great monetizations, right, the ability to transact with items denominated in money, is not a feature of all of human history. It's really a feature of history post the plague, right, post the Black Death. And, that's kind of the first turning point, I think, in financial history. So we've had coinage for a long time. But for example, in Europe, your obligations, your feudal obligations were denominated in kind, right? Taxes were collected by the English crown, right? It was like, you might owe 3 honeycombs and 1 sheep and 2 bushels of corn, right? It's really after the disruptions of the plague, because you have a labor shortage and you have kind of this loosening of the social ties, that people start denominating both tax obligations and mutual obligations in currency. Something analogous happens in China, and that's driven a lot more by population growth, and it's the big commercializations during the Ming Dynasty, which creates a lot of consternation in the elite literati kind of scholars. Right, they think it creates kind of perversions and confusions. But that's really the first great innovation, and for me, in my mind, right, that really it's when you have Bitcoin and you can attach price to it, that you can really start begin that process of monetization. At this point, DeFi is entirely monetized. It's monetized in dollars, right? Not in ETH, really. But that's really the first thing that happens. The second thing that happens is what I would call the um, kind of almost one-to-one relationship-driven lending, right? And so this is sovereign, if we're looking at sovereign bonds in Europe, the interest rates are really high. They're like 25%, 35%, which might sound familiar for people that are playing on DeFi. But these loans are heavily collateralized, right, with land, jewels, gold, all this other stuff, right? It's not this under collateralized lending that people think defines modern banking. It's really just merchant families lending against property that is held by this feudal class, right? So it's a class that has a lot of property and they just need liquidity. So if that reminds you of whales that got in on Bitcoin or ETH early, have a lot of property, they don't want to sell it, but they need some liquidity. This is where those markets come from. And that's where you see Aave Compound kind of come to the fore. You then have exchanges, I think, liquidity provision through Uniswap. That's analogous to the rise of exchanges, which happens a little bit later around the 1700s and 1800s. The pieces that are missing, right, in DeFi are pieces that came about earlier in the financial stack, in the traditional financial stack. So bonds, right? The bond market is actually much larger than the equities market. And it was vastly more important in, say, allowing Britain to defeat Napoleon, in the rise of sterling as a world currency, anchoring that, British dominance in general, and in terms of being an asset class, right? It's very large, and so that happens in and of itself, right, as a means of financing wars. But the follow-on effect is that state bonds are really good collateral for then creating private monies, right? So you set up a banking corporation, you say that it's collateralized by railroad stocks or railroad bonds, and then maybe some state bonds, right? And so, as kind of legislation gets passed, the state forces the banking system to use state bonds as collateral for these private monies. And so you can sort of see how these things kind of stack up, right? Like you need the monetization first, then you need this borrowing, then you need people to discover bonds, then you need exchanges, then you need these money notes, right? Which are the banking corporations for private issuance of money. And then, you start at that point to start getting insurance and options, which really only flourished in the 1980s. And then you get securitization in the early 2000s, right? When you just start tranching things into pieces. What's different with DeFi is that tranching is actually really easy to do. So you can put that all the way at the bottom and you can rebuild a lot of these instruments in a way that looks very different, but still fulfill the same function. So I hope that's a good walkthrough through, I guess, all of human financial
No,
history. That's a good summary.
no, that's really good. And so we've got these pieces of the financial stack or I should say, these pieces of the stack that exist in historical finance that don't necessarily exist in, let's say, cryptocurrency or decentralized finance. The next question that goes to my mind is, what pieces that don't exist are necessary? I mean, are there certain parts of that stack that decentralized, let's just say decentralized finance as a whole can look at and say, well, we don't necessarily need that piece to function properly or to grow and build?
Yeah. That's a hard one. So I think options are overrated. I know a lot of the nerdier, geekier builders in DeFi, especially those with experience in high frequency trading or more advanced math, would like to build options, but options begin as a means of hedging real risk, real economy risk, right? The word hedging, I don't know if you guys know this, but it comes from the plants, the hedges. So when you're transitioning from a common land system, right, the commons to private land, the way you delineate properties is by planting hedges. Those hedges kind of grow tall and they're kind of self-sustaining. So the idea of hedging risk is really the idea that you can cleanly define what the risk is and you hedge it, and then you pay someone to take it, right? You sell it in an exchange, basically. And so this is really valuable when you're engaging in risky ventures, right? Whether transatlantic trade or long distance trade, things that you get lost, or if you're a producer, if you have certain risk in your price inputs, right, from corn or whatever it might be. And so up until I believe it's the 1960s or the 1980s, something like 90% of all options volume is actually with people that have real world exposure, and they're actually hedging risk. What happens, unfortunately, I think over the last 40 to 50 years is the options market becomes a casino of sorts. And so then the volume that relates to real economic activity is really small. And so in my mind, it's an instrument that does not add much real value, right? No one's really hedging or transferring risk in a useful way. It's primarily a betting casino, in the same way that I think a lot of tokens became, online on-chain casinos. A lot of token systems became on-chain casinos. So I would hope people start paying less attention to options and doing something else more useful. I think the one place where options are useful, and I know companies like BScene have taken the lead on that, is for proof of work chains. So Bitcoin, right? You do have exposure to fluctuating electricity prices, a whole bunch of other things. And so miners do in fact need to hedge their exposure to have enough cash flows, right, to meet expenses in the real world. And that was probably the one use of hedging that I thought was useful, but that was provided by a centralized entity, so it wasn't even on chain anyways. So that's my take on that.
I cut off Mod a minute ago, so I want to turn it over to him. But before I do that, I will mention that in real life, I work in oil and gas. And let me
Yeah,
tell you, I spend a lot of time talking about hedging and options. And I agree with you that, I have witnessed small mom and pop oil and gas companies lose it all because of options reliance or poor hedging and not managing risk against price fluctuation. And it can be super
yeah,
dangerous.
yeah. I mean, what happened in March of 2020 when people had oil options contracts and then suddenly they had to be physically settled, and they were like, wait, I'm receiving all this oil, but I have nowhere to store it because I don't actually use oil in any way. And suddenly they were willing to pay other people to take the oil because they had nowhere to store it. Suddenly you say, all right, so most of the system is in fact not doing anything useful if in fact this is one of the outcomes.
It's absolutely right. Go
Yeah.
ahead, man.
So all I was gonna say to our listeners is that the timeline that we're discussing, we're talking about, is on Buttonwood Foundation. Sorry about that. That's all I wanted to say.
Thank
Perfect.
you.
Yeah, we'll make
Yes.
sure to direct everybody to the site. That's a good mention. Man, Manny, I feel like I want to just sit and have a beer with you because I have a lot of other thoughts on this exact conversation, but I want to keep it pod related.
Yeah.
So anyway, to pull it back into to Buttonwood. So if Buttonwood's goal is to provide a, let's say, a relatively accessible option for the multitude of the financial stack in DeFi. How do you do that? Do you do that through like specific tools that developers can access, or how does that work in a practical sense?
So I had to answer this question at an investor dinner recently. What I would have told you a year and a half ago is that from a contract design perspective, I think we provide a very good architecture for other products to then build upon, right? So the um, what I would say the mainline events happening in the next month is there's a team that formed and won the Chainlink hackathon called Hourglass, and they're building convertible bonds using Buttonwood contracts. And Eric Voorhees' DAO Shapeshift will be issuing, I think, between $500,000 to $1 million worth of convertible bonds on top of that. So we were originally going to tweet about it after Eric and SBF had that debate, but then the collapse of FTX kind of overtook all of that. So, but that's one example. The other example is the Ampleforth team is releasing in December Spot, which is an inflation-resistant store value token. So it's basically a token that just its value increases based on inflation. So it's an inflation hedge. And so that market, all these spots will always trade with a premium, which reflects the inflation expectations of the market, right? So it's a little bit like tips. And so, they're using some of our contracts, the tranching contracts, to build these other products, and we're happy with that. So that's one answer: is we provide a very good architecture. I think the other answer, which is unfortunately the true also real, is that I try to provide help, I think, to a lot of other teams in their contract design, and so I think that also leads to some of the adoption of some of our contracts as well, right? I think smart contract design requires attention to a type of elegance and simplicity, which I think sometimes gets ignored. And I think that the right mindset to design, by the way, so every time we hire one of our engineers, we give them these smart contract take-home assignments. And I think every time the assignments come back, I just never want to hire anyone. But I think it's a learned process. So, none of the engineers that currently work for us would have worked for me, would have not worked with us if it had just been up to me, because I didn't like any of the solutions to provide. But I think people kind of pick up on this instinct. And I think there's two pieces here. I think one is really thinking about the robustness and simplicity of the instrument. So you try to make it as small as possible. And the second thing that really matters is thinking about decentralized finance and traditional finance as systems that evolve and converge, but are never equivalent, right? So consider that birds evolved wings first and learned how to fly. Bats also evolved wings and learned how to fly. But a bat is not a bird. I mean, it doesn't need to replicate egg laying, having a beak, all these other features, right? They both evolved similar functional, appendages, but they're not equivalent. And I think DeFi is very much like that. And so I think one of the big leaps that happens that a lot of people don't make is really accepting the very unique environment that on-chain instruments have, right? Everything's public. There's no private information. You have high transaction costs, high information latency. So that's very hard. And, kind of to bring it all the way back, this is why history is really important here, right? For most of human history, finance function in an environment with incredibly high transaction costs and incredibly high information latency. If you wanted to buy a bond in 1815 in London or 1780, whatever, you would probably have to send Maud on a ship to London to go buy the paper security, right? To like make a bid in person at this market. The market's cleared once a day if you were lucky, right? Even up to the 1950s, the stock market only cleared once a day. There was not enough volume. So if you could build the entirety of the modern world in a high transaction cost, high information latency environment, you can surely build it on chain in the same way. So look into history is a little bit like cheating. You look at all the things that existed in that really tough environment and you try to rebuild some of them. Some of them are actually useful.
I want to be clear that Mod's the brains, so he would be sending me with very clear instructions. He'd be saying, okay, Rex, here's what I want you to do. Please don't mess this up again. We overlooked it the first time.
I'm just enjoying this. I'm just enjoying this and listening. But it reminds me of a story, I think, Manny, and I actually don't remember it now quite well, or if this is as accurate as it is. But I think sometime in France, probably during the 1800s or maybe late 1700s, is that they used the military post to send messages. And there was this trader who would then bribe, or who bribed one of the, whoever was the government employee that would send these messages, and then they would get early messages on, stock prices or news, and they would be able to, to bet and, basically arbitrage or make money on the market then. So yes, I agree with you on the development of markets and the cost of latency and these things getting better, and it is something that we're experiencing maybe in the infancy of in Web3, but it is expected to improve.
Yeah. I think you might be referring the famous apparently false story about the Rothschilds having early access to the news of the outcome of the wars against Napoleon, and then either buying or dumping bonds based on
possible because the story in my head has Napoleon as well, so it could
yeah be. So there's a wonderful book called The House of Rothschild. There's 2 volumes. It's by Neil Ferguson. It's the definitive treatment on the topic. Turns out that that's not true, at least for that specific battle. But yeah, there was an advantage in having your own courier system, which they could afford, right? Their own system of mail, which was faster than government use.
So, really what goes through my mind, Manny, is with your historical knowledge and experience and what Buttonwood is trying to achieve. I think you can pretty quickly turn your viewpoint from the past towards the future. So when you think about what is coming, what projects and protocols and needs decentralized finance has, what goes through your mind? What are you looking at or thinking about when you think about the future?
So many answers. I can give you let me break that down into 2 parts. The first part is kind of what we're working on. And then the second part is what I hope somebody else will do that we can't do. So I think the Buttonwood ecosystem has proven itself really good at building kind of 3 types of things. So one of them is these non-callable instruments, most commonly known as bonds, right, in the traditional market. And an adjacent problem to that is mechanisms for settling exchange, right? So we deployed a 2-sided auction recently. And so 2-sided auctions are relatively understudied because they're just not that common anymore. That used to be how you created liquidity on equity exchanges up until the 1930s, right? That's why you have an opening price and a closing price. You accumulate kind of bids and then you settle at the end of the day. And so you have 2 prices that get recorded. Once you move to a continuous auction model in the post-war era, nobody really cares about these things. And most of the research is really on 1-sided auctions. And that's, in your classic textbooks, which I have one here, the textbooks, that people study in grad school. Yeah, Auction Theory by Krishna, right? It's primarily 1-sided auctions. It's kind of what you use in ad sales and all these digital marketplaces. And so most of the auction designs out there are single-sided. whether they're Dutch or sealed bid, whatever, it doesn't matter. But the problem of settling trades for bond-like instruments is actually also a problem in traditional finance that goes relatively, it's still kind of like a wobbly space. So equities trade on, central limit order books, and you have market makers that provide liquidity. And you, by participating, you're also providing liquidity, right? Because your bid gets settled immediately. But bonds have kind of this request for quotes system where somebody just broadcasts this, request for quotes. I have some bonds, right? And usually these are institutional players. So you have a large amount of bonds and you're asking for bids. And then you kind of settled these large trades in this way. So the liquidity is not super visible. And it doesn't look at all kind of like what you would expect from a central limit order book. And so that's, I think, a question that we're still trying to solve. So the double-sided auction can really help in being the primary market for a new instrument. But it's unclear to us where the secondary liquidity will live. It's, at this point, clear that Uniswap v3 is severely deficient in providing liquidity for instruments of this sort. And so that's kind of one of the things that we're working on is like other mechanisms for settling peer-to-peer exchange, right? And so we're working on building that. The other thing that I think Buttonwood has been really good at, which I think is probably the future of finance, is what I would call vaults. So vaults are basically contracts that have three sets of rules. One is for depositing and minting kind of deposit slips. So you deposit some asset, you get a little token out of it. Redemptions, right? Rules for bringing the slip back and getting something out of it. And then the third set of rules is what's happening on the back end, right? Is it investing it somewhere? Is it not doing anything? And so, I think the spot the spot contracts are basically of this sort. All they do is they accumulate all these ample tranches, but the spot token itself is just something that you just hold. And so I think the space of outcomes that you can get by manipulating, I think the three sets of rules produce very nice set of properties. It's a nice open space, I think, full of problems. And so there's a couple other things that we're building there around potentially, fully on-chain collateralized stablecoin designs, backed by assets of this sort and so on. So, and again, you can see the historical parallels, right? You create money notes when there's a shortage of money by taking long-term debt and stuffing it into a vault, otherwise known as a bank, or a Qinzhuang or whatever in China. So these institutions exist everywhere in history, but that's kind of what we're working on. So outside of what's happening in the Buttonwood ecosystem, there's the second group of things that I think will likely happen now. And so one of them is, I think, the decline of centralized exchanges. I think at this point, what happened with FTX, I think, is a great example of a pattern you see repeated all throughout history, which is the crisis always begins in the most heavily regulated sector of the financial system, right? If you think about what happened in 2008, everyone thought it was the hedge funds that were going to blow up, but it was the banks. And because they held assets from mortgages, which are also heavily regulated. If you look at the fallout of the Volcker shock, right, in the end of the 1970s, when interest rates spike up to 10% and beyond, is the Savings and Loans Associations, right? It's the greatest number of bank failures since the Great Depression. Again, pretty straightforward, regulated institutions. There's this broader problem in traditional finance, which is the government backstop provided to deposits and kind of runnable contracts, of which banks are one type. And I think what happens is, because the bank continuously commits to backstopping demand deposits, that sector just continues to grow bigger. So when I was young, 12, 13 years ago, as everyone does, they read Lombard Street by Walter Bagehot. And he makes the argument
I
that the
read it
central bank
twice.
is...
It just happens.
Yeah, right. And so here's the thing, right? You read that book the first time and you say, yeah, of course, the central bank is the lender of last resort. You backstop the banking sector so that there's no instability. And I feel like now that I'm older, I look back on that and I say, no, the answer is exactly wrong. It's the government backstop of the demand deposit market that allows it to grow even bigger. And every time there's a crisis, everyone says, oh, well, if only the guarantees were slightly more, then we won't have a crisis. And this gets legitimated intellectually through the Diamond and Divig kind of article in the 1970s about deposit insurance, saying that that's a much more effective way of backstopping the financial sector. So now you add insurance on top of this. And so you have moral hazard that emerges. And I think the lesson from history is that you have traditional finance is very opaque. You don't know who the counterparties are. And even in a digital era, people don't know where the instrument ultimately cashes out in, right? If you have a derivative of tranches of tranches of tranches, like you don't know what the ultimate mortgage is, right? Where they are. And so it's very opaque. And I think that's why the government regulates it, which I think is a mistake. I think they could just not regulate it and let it shrink on its own. I think crypto, in particular DeFi, is unregulated, but it's also transparent. And so what you see now, right, is the government is not going to save FTX. They're not going to save any exchange. There's no bailouts coming for crypto because most people think it's useless. And I think that's actually good, because what's happening is you'll see an unwind of all these opaque relationships. All these opaque entities will wind down. And users are demanding things like proof of reserves, right, on-chain. What I think this will create is a pressure on exchanges to put more and more of their infrastructure on-chain. And at some point, the exchanges become kind of this on-ramp layer that gives users access to infrastructure that exists on-chain. And that only happens because the government, in fact, does not provide any backstop to people like Coinbase or, Binance and so on. So somebody I think might build a good competitor that's built around kind of these DeFi first principles. So that's not going to be me, but that's a business idea for your listeners. I'd be more than happy to provide some seed funding for that and some advice. But somebody needs to build it. I definitely. Yeah.
I think that is very, very insightful. So we've already kept you over time. One more note that I will give, something I really appreciated as I was reading through Prometheus' information, was how helpful the guides were. And, when I'm reading this, I am in the process of talking with friends and family about what DeFi is and like looking for really good resources. And I would say that the Prometheus resources, the guides, were probably some of the best that I have seen in terms of how relatable they are and how useful they would be for somebody that's very new to the space.
That's great to hear. I mean, they need to be updated. But I spent 90 minutes helping someone reconnect their old ledger to their computer the other day. Very, very smart person. But, this stuff is still a little bit hard to use. So, but yeah, so Prometheus Research Labs is one of the projects that works with the Buttonwood Foundation to build out their contracts. So I would say we're probably their primary contractor in terms of building the core contracts. But as I've mentioned before, Hourglass receives grants from the Buttonwood Foundation, and as well as a couple other teams. But yeah, that's kind of our role there.
Perfect. And so Mad just mentioned Buttonwood Zero.
Yes. So Buttonwood Zero, a zero liquidation Web3 bond, and you start this, Manny, by saying margin leverage is best suited for the sophisticated traders. And the solution here is, a non-callable or, a bond that doesn't get, liquidated. Can you maybe take us through, we've briefly maybe discussed, maybe the idea or the motivation behind such a product, but can you take us through, through it again? Why do we need such a product, and then how does it work?
Yeah. So margin leverage is, in fact, I would say 99.9% of all leverage on DeFi. So basically, the way that it works is you put up an asset and then you borrow against the value of it. And the reason it's called margin is that the value of your loan and the value of the asset are supposed to stay above a certain margin, right? So if the value of the asset falls below that margin, you get margin called, which means the asset gets sold and to pay back the lender. That's Aave and that's compound. And in the traditional world, that's what your brokerage would do, right? You put up some stocks or other types of security and you borrow against them. And what's funny is that there's this obsession with capital efficiency. People, are trying to reduce that margin to ever smaller amounts. And I think liquidity, for example, that's kind of their pitch. The problem is margin leverage has this property, which is really just a mathematical property, which is that it has asymmetric exposure to the downside. So if the value of your collateral falls sharply because of high volatility, you get liquidated, which is equivalent of selling it at the lowest price that it hit. And then if it bounces back up, you don't see any gains. And of course, if the value of your collateral appreciates while you have borrowed, you get no benefit from that either. And so what happens is, and there's many studies on this, but you can model it very simply if you just have a wobbly line and then kind of a filter at the bottom is that on average, the average investor, their returns are worse if they use margin leverage than if they had just not used leverage. And it's entirely because of this asymmetry that leverage introduces into their portfolios. And so, this is kind of obvious when you explain it this way. And then it's a little bit more obvious if you think about how traditional financial markets are structured, which is almost nobody uses margin leverage in the real world, right? Only hedge funds really use it and people on Robinhood. Governments don't borrow this way. Companies don't borrow this way. There's, 95% of the market is fixed duration, non-callable debt. The perfect example of non-callable debt is your home mortgage. If your house goes down in value, the bank doesn't liquidate your house and kick you out. I mean, that would be ridiculous. You might choose to not pay your mortgage anymore, but that's a default. That's a very different type of condition. And so what Zero seeks to do is to provide an alternative to margin leverage on-chain. And so right now, the way that it's structured, it will be permissionless soon, but the way that it's structured is you can take your commodity-like digital assets like Bitcoin, ETH, Ample, and you tranche it. So you create a senior claim and then your equity claim. And the senior claim is basically like a mortgage. And so you sell these mortgages in the zero market and you get your loan. And so it's like a home mortgage, right? You have, half of the value of your home. The safest half is pledged to the bank, or in this case, your lender. And they have given you stable coins. And someday in the future, you'll pay back the stable coins and get your claim back. And if you don't pay back, then that's when, in fact, the house gets repossessed, or in this case, the collateral gets liquidated. And so that's basically what we do there. And that's what the zero market is. There was an earlier version of it called Mooncake, which launched, I think, Christmas Eve of last year because the dev team was running late on it. But that was the original iteration of it. So it's basically the nicer version of Mooncake. So that's Zero. So it just allows you to borrow non-callable debt, not on margin, liquidation free against Bitcoin, ETH, and Ample.
Okay, Manny, if we can talk about an example, and you have that example on the white paper, and then we talk about, let's say someone wants to come and borrow against, let's say, $100, and then you would split that into two tranches, the Z and A. And as you call it, the senior tranche, and maybe the one that's safer. And then you give an example of what happens if the price of ETH in this example goes up or down by 50% or drops by 50%. And in the first example, if it drops by 50%, then the Z tranches are the ones that basically absorb all of the volatility, and then they're worth nothing or they're worth zero, right? But the A tranches are still worth what they're worth. And then if the opposite happens and the price of ETH goes up, then the Z tranche is the one that captures the increase, again in volatility, but because the price increased, so now they're worth more. They're not worth zero. They're worth 10. But then the Z tranche, or sorry, the A tranche or the safe tranche is the one. It's still worth $5. That didn't change. Can you so the A tranche is meant to be the safe one, right? Because the Z tranche is what's absorbing the volatility. In this example, the price of ETH went down by 50%. What if it goes down by 80% or 90%? So that means the A tranche will eventually still go down in price. Is that correct? So it is safe, but it still has the risk of losing, under extreme volatility.
Yeah. So it is, when you mortgage your house, right? If it goes up in value, the homeowner gets the appreciation. And depending on how much you mortgage the house for, if the home goes down in value, the bank should still be whole. But let's say the home gets destroyed and you didn't insure it, right? So the home goes down to almost nothing, right? It is possible that, when the bank forecloses on the home and sells it on the market, it's not going to make back what it lent you, right? Because the asset has no value, or, the value of the land, but, it's not nearly enough to cover what it lent you. So that's entirely possible. It's not risk-free. And so what's important there is setting parameters that make sense, right? Like, most homes are relatively safe, so the bank can lend you up to 70 or even 80% of the value of the home. I don't think people should be lending on 80% of the value of crypto. I think it should probably be like 30. It depends. The market should sort that out on its own, but it's definitely should be less, I think, than 50%.
Understood. I guess my two questions now would be, is the thesis, and this is what you've mentioned, or maybe alluded to earlier on, is that having such a system or having such a product with, that's non-callable or doesn't liquidate it creates an overall general, let's say, stable market that's, more, has more appetite for, people to be in, just given that, it's less or reacts better to volatility, let's say. But if the price, in our example again, if it drops down by more than 50%, is there anything stopping those who are holding the A tranche from, selling it and effectively, liquidating it?
So I wouldn't call it liquidating. It would be like your bank saying, Mod's a deadbeat. He's not paying back this
Yes.
mortgage. We're going to foreclose and only recover I don't know, maybe in the best case, 80 cents on the dollar. So then your bank says, hey, Rex, Manny, you guys want to buy this mortgage on 60 cents on the dollar? And we're like, okay, that sounds pretty good. We'll put in a little bit of effort and maybe hope to get an extra, we'll get the 80 cents. But the bank can just sell it. But that wouldn't affect actually what's happening to you in terms of your own home and what's going on with that process. It's, you can sell and trade back and forth all these assets on the back without triggering a liquidation or foreclosure or whatever that's going on with you. And so banks do this all the time, right? They sometimes sell the loans of their riskiest borrowers. They sell it to another firm because they just don't want to deal with it or they think it's too risky.
Clear. Okay, those who hold the Z tranche, and as we said, the Z tranche is the one that's captures most or captures the volatility. Would you describe them as kind of like they're leveraged, just given that they capture all of the upside and the downside? Is that equal to an extent?
So this is again, I think you're getting to a very profound point, which is that tranching can create all sorts of instruments, right? It creates mortgages, it can create options, it can create this inflation-resistant safe asset. It can also be interpreted in some ways as leverage, right? Because you have now multiplied the exposure that you have to the price movements of the underlying asset, in this case, your home, right? So getting a mortgage is going levered on the home market, basically. or on crypto. So yes, it can be interpreted as leverage. It's not pure leverage on its own, but it does have that property. And I think that's a very good interpretation.
Yeah, I think it's great, and it splits, and then different users or different participants have different options on what they seek or what fits their appetite. Thank you, Manny, for explaining this.
No problem at all.
This is great. I know we're short on time, so Manny, for just the last minute, I want to just turn it over to you. Is there anything else you want to cover, or you want to mention, or talk about? The floor is yours.
Well, we're trying to work with one of the Beanstalk family teams, irrigation protocol. So hopefully we end up doing something with you guys using the Buttonwood contracts and the irrigation protocol contracts.
I heard that.
Music to our ears.
Good crew. Yep, they're a good crew.
That's what we want to hear.
I know. I mean, at this point, it's very likely that most of the TVL into Buttonwood comes from projects that I didn't actually directly build, which would be really, really good. So Buttonwood was born decentralized first, right? The foundation is fully decentralized already. I'm not part of it. And we have all these teams building on it. But yeah, hopefully Prometheus comes up with a killer app at some point. But yeah, we're working on something with irrigation, and I'm not entirely sure what the architecture of that will be, but hopefully we'll have more details for you guys soon.
We'll keep an eye and we look forward to it, whether it is something that has to do with Beanstalk or just Buttonwood and Prometheus in general.
Perfect. Thank you so much for having me, guys.
Thank you, Manny.
Yeah, Manny, this is a pleasure. Thank you so much for joining us. You can find Buttonwood on the web at button.foundation and on Twitter at ButtonDeFi. You can find Manny in a whole bunch of different places. Probably the best are on Twitter at Rincon-Cruz. That's MRINCONCRUZ. And on his personal research website, thinking.farm. We'll also have more links in the show notes. The Bean Pod is a production of Beanstalk Farms, a decentralized autonomous organization. You can find us on Twitter, Instagram, Medium, Discord, and our home on the web at bean.money. You can also find me on Twitter at RexTheBean. And as a final reminder, this podcast is not financial advice. Thanks again for listening.